and partnership between NAFA and our great friends at the Society for Financial Services Professionals. This is a continuation of our Advanced Practices workshop. I will ask you to please submit your questions in the chat room, and we have reserved 12 to 15 minutes at the end of this to ask your questions of our panelists. We also, the title of this presentation, Challenges and Opportunities, Winning Solutions in the New Legislative Landscape. And we have designed this seminar to present practical planning ideas after the Tax Cuts and Jobs Act of 2017, the Secure Act of 2019, the CARES Act of 2020. Please submit your questions through the chat room. Now what I'd like to do is turn this over to my good friend, Kathleen Bilderbach, who is on the executive committee of the Society and is a board certified tax attorney out of St. Louis, Missouri. And she's also a big St. Louis Cardinals fan, so that makes me very happy. Kathleen, I'll turn it over to you.
Thanks, Keith. And thank you for letting us be here today. Next slide. My topic is creating business cash infusions through net operating losses. For those of you who are not familiar with a net operating loss, it occurs when a company's deductions for the tax year exceed the company's income for the same year. The year in which the loss occurs is referred to as the NOL year. Taxpayers can use those net operating losses to offset income in other tax years. Next slide. So we've had a lot of changes in the NOL rules over time. So prior to 2017, NOLs could be carried back 2 years prior to the NOL year and then carried forward for a maximum of 20 years. The Tax Cuts and Jobs Act of 2017 eliminated the carryback of losses. So from the time that the Tax Cuts and Jobs Act was passed, you could only carry NOLs forward. In addition, the NOLs could only offset 80% of taxable income in those future years, and they could be carried forward indefinitely. Next slide. Earlier this year, Congress passed the Coronavirus Aid, Relief, and Economic Security Act, otherwise known as CARES. One of the things that CARES changed was the treatment of net operating losses. So under the CARES Act, net operating losses from 2018, 2019, or 2020 could be carried back up to 5 years. In addition, those NOLs can offset 100% of taxable income. This is going to allow taxpayers to receive a refund for taxes they paid in prior years. And if you recall, prior to 2018, the corporate tax rate was 35%, not our current rate of 21%. Taxpayers can still waive the carryback and carry losses forward to subsequent tax years. So we're going to talk a little bit about what some possibilities are in using those losses. First, however, we have a simple example. Next slide. So here we have a C corporation. In 2018, this C corporation had taxable income of $800,000 and deductions of $1 million, resulting in a net operating loss of $200,000. Under the CARES Act, that C corporation can carry back the net operating loss of $200,000 to any tax year 2013 or after. So let's assume that in a prior year, the C corporation had taxable income of $200,000 and paid taxes, again, at the 35% rate of $70,000. The C corporation can now amend its prior year return and claim the refund of the taxes it paid. If the C corporation has additional losses in 2019 or 2020, it may be able to claim multiple years refunds and carry any additional losses forward indefinitely. So now let's get to some of our planning ideas. How can your clients or you use those NOL dollars? First possibility, next slide, is by putting in a phantom stock or a phantom equity plan. And I should tell you, I use those two phrases when I present back and forth. Basically, a phantom stock or phantom equity plan gives the participant the right to receive cash at a specified date in the future based upon the performance of company equity over a specified period of time. And the structure can take a number of different forms. These phantom stock or equity plans can be used by a variety of different companies. So C corporation, S corporation, even an LLC, text as a partnership. Generally, we use these where the owners don't want to dilute ownership, but they want the participants to feel that they have an ownership interest in the company. Sometimes the owners put these in place because they only want to pay the employees if specified events occur, such as a change of control. The amount of the benefit here is linked to the company value. It is a form of deferred compensation plan, however, that is subject to Section 409A. For those of you who are not familiar with 409A, it basically governs not qualified deferred compensation plans. It puts some penalties in place for plans that don't meet its requirements. One of the penalties is all of the vested accrued benefits become immediately taxable in the year of plan failure, and that taxable amount is also subject to a 20% penalty and interest charges. Next slide, please. So when do these plans pay? Well, under Section 409A, there are some very specific times that the participants can receive benefits under the plan. One is separation from service, and that can either be termination of employment, termination of an independent contractor arrangement. It can be defined as a voluntary separation from service, an involuntary separation from service, or both. Death, disability, but it has to be as defined in Section 409A. If you don't define disability correctly, you could have an inadvertent plan failure. It can also pay a change of control of a company as defined in Section 409A, an unforeseeable emergency, or pursuant to a specified time or a fixed schedule. Next slide, please. So how are these plans taxed? Well, normally the executive is taxed at ordinary income rates and the company gets a deduction when the benefit is paid to the participant. So here we have Anna, who received 1,000 shares of phantom stock, which will pay a benefit only upon a change of control of the company. So here, Anna is not taxed at the grant. If there is a change of control of the company, she gets paid her benefit, and that's also when the tax occurs and the company gets its deduction. Next slide, please. So why are these plans popular? Well, employers like them because there's no dilution. They have a minimal impact on cash flow. Employees like them because they get tax deferral. Employees find some of the trade-offs to be that they don't have any voting rights or dividends, while the employer may find the trade-off to be no deduction until the benefit is actually paid. Next slide, please. So what's another possibility? Another possibility to use your NOL dollars that you've claimed is to put in place a supplemental executive retirement plan, or SERP. A SERP is a 100% employer paid type of non-qualified plan that provides benefits to a select group of employees. Something to remember about non-qualified deferred compensation plans, they're subject to two regulatory regimes. First, the IRS, and basically that means Section 409A, as we just discussed. They're also subject to ERISA unless they meet some sort of exception. The exception that's most commonly used for SERPs is that it's designed for a select group of management or highly compensated personnel. That means it's a top hat plan. The top hat plan avoids most of the ERISA requirements. So it's much more flexible in terms of what you can do for that top hat group. It can be defined, it can be either a defined benefit plan or a defined contribution plan. So let's take a look at the differences between the two. Next slide. So if we have a defined benefit SERP, the employees can't contribute. The employees don't receive employer contributions as current income, however, the income inclusion is deferred. One of the drawbacks of having a defined benefit SERP is it has to be designed carefully, or there can be an unknown funding liability for the company when it's put in place. For example, if we have a defined benefit SERP, which basically bases the benefit on the employee's final salary, it's difficult maybe 20 years to know 20 years in the future what that employee's final salary is going to be. So in order to manage the funding liability, frequently we'll put in a defined benefit SERP that says, for example, the participant will receive $100,000 a year for 10 years upon their retirement at normal retirement age. That gives us a target for the funding of the liability. The plans can include, and frequently do include, vesting schedules. I would say that now defined contribution SERPs are more common. Next slide, please. With a defined contribution SERP, the employer is going to make contributions to the plan for a specific number of years in a specific amount. Again, the employees do not contribute to these. The employees don't receive any taxable income when the employer contributes. And again, the plans can include a vesting schedule. Next slide, please. These plans are usually used by the employer to help recruit, retain, and reward highly compensated executives. The employers like them because they avoid all of those ERISA requirements. However, we need to make sure that they're meeting the requirements of Section 409A for IRS purposes. The employees like these plans because they're 100% employer financed. They are, however, subject to the business fortunes of the employer. So if the employer, for example, goes bankrupt or has creditor claims, any benefits would be subject to those claims. So there's not the same kind of security for the employee as they have with a qualified plan, for example. Next slide, please. So one thing that I didn't mention, because we're not really doing a deep dive on this call, we're just providing a few planning ideas. Non-qualified deferred compensation plans are informally financed. So there are no assets set aside to fund these plans. That's an unfunded promise to pay. However, a lot of employers use life insurance to informally finance these plans. And they do that for all of the reasons that life insurance is such a valuable asset, because of the tax-deferred cash accumulation, the tax-free access to the cash value through withdrawals and loans. The company receives the death benefit income tax-free, provided it complied with Section 101J of the code, and the employer can get cost recovery from the proceeds. Now, of course, there are a few challenges depending upon what type of policy you're using to informally finance these plans. There are high early policy charges sometimes. Obviously, it's difficult to use policy values to fund benefits for older participants, frequently because there's not enough time to build up enough cash. And the premium payments, of course, are not deductible. Next slide, please. So with a C corporation, so we just talked about how a C corporation can use its NOL dollars. Now let's talk a little bit about S corporations and partnerships. NOLs present real opportunity for S corporation shareholders and partners in partnerships to use losses against other income. It's important to understand that in order to deduct their losses, owners of S corporations and partnerships have to have basis. So how do they get basis? They acquire basis when they make contributions of capital to the company. One question that I get a lot is, what about debt? And S corporations and partnerships, people think of them the same way because they're both flow through entities, but really there are some important distinctions, and this is one. If an S corporation borrows directly from a third party the owners don't get basis. However, if the shareholders borrow from a third party and then in turn lend the proceeds of that loan to the corporation, the owners get basis. A partnership, however, when a partnership gets a loan from a third party, they typically get basis. Again, this is important to understand because the owners have to have basis against which to deduct their NOLs. Next slide, please. So let's assume that we have Acme Corporation, which is an S corporation with 4 shareholders, each of whom own 25% of the company. The owners have been considering a cross-purchase buy-sell strategy for a number of years, but traditionally this requires numerous policies. So every shareholder has to own a policy on every other shareholder. So here that would be a total of 12 policies. That can be very overwhelming to a lot of clients. In addition, the company has been spending its free cash flow for the last few years on building up the company growth. However, the company now anticipates that it's going to have a substantial net loss for 2020 as a result of business slowdown due to the pandemic. Next slide. The net loss is going to flow through Acme Company to its shareholders on their K-1s. Each shareholder has plenty of basis because several years ago, they each personally borrowed $250,000 and in turn lent it to the company. The shareholders will take the loss from 2020 on their K-1s and amend their tax returns for prior periods. They will receive refunds. The company's advisors have suggested that now's the time to put in place that cross-purchase buy-sell arrangement. And they have suggested a buy-sell LLC to effectuate that cross-purchase. Next slide. So for those of you who are not familiar with the buy-sell LLC, the owners of the company execute a buy-sell agreement, a cross-purchase buy-sell agreement. Then the owners establish an LLC to purchase life insurance, insuring their lives. This LLC has a specially designed operating agreement. So your run-of-the-mill, plain vanilla LLC that you get off of LegalZoom is not what you want to use for this. Otherwise, you may not get the results you desire. So the owners establish the LLC. The LLC purchases one life insurance contract on each of the owners. The owners contribute money to the LLC as capital contributions, which the LLC in turn uses to pay premiums. If an owner dies, the proceeds from the insurance on his or her life are allocated to the surviving owners. The surviving owners then use that money to purchase the deceased owner's stock from his or her estate. And in addition, the members retain access during their lifetime to the cash surrender value of the policies owned by the LLC. So the LLC can use that for cash surrender value for a lifetime buyout of a partner or other uses. So one of the ways in which S corporation and partnership owners can use their refund dollars from their NOLs is to set up and move forward with their business continuation planning. Next slide. So thanks everyone, that's it for me. Now I'll turn it over to Ron Lee, Vice President, Advanced Markets and Brokerage Field Relations for Mutual of Omaha. Ron?
You're on mute. Excuse me. Thank you, Kathleen, for that great information. What I'm going to be talking about over the next 15 minutes or so is the Secure Act. And frankly, the Secure Act was kind of a big deal. But as everyone on the call knows, this was a year of a lot of big deals. So it got a little lost in the shuffle. So what I would like to do is I want to share a little bit of information about the beneficiary options for individuals under the Secure Act. And anytime you listen to a meeting like this, I think you should be asking yourself, what do I do with this information? And I think the answer to that in this particular case is that take your notes, listen to the call. But then when you finish, look through your book of business. Figure out which of your clients have IRAs, especially ones that you've talked to about stretch options, and then just call them up and say, hey, we need to have a beneficiary review. And no one's going to turn that down, right? But don't just do that. Also take the opportunity to say, you know what? In addition to that, we really need to talk about your life insurance, because if you die prematurely, then of course, there won't be enough money there to transfer on to the next generation. Of course, if you become disabled, then you're really not going to save up enough to pay for your own retirement and transfer something. And then finally, of course, long-term care. If you need long-term care in retirement, then you're going to spend most of what you have saved up. So luckily for them, you have the tools, you have the products to fix those problems. And I just encourage you to make sure that you are that you're addressing that. Next slide, please. So what happened here with the stretch? Well, the first thing that we need to figure out is, who do these new rules apply to? And the answer generally for most folks with defined contribution type plans is that if the owner died in 2019, the old rules apply. If they died in 2020, then the new rules apply. Now, there are some exceptions. If you have a collectively bargained plan, or certain governmental plans have a later start date, but as a rule, in 2019, if you died, old rules. 2020 or beyond, new rules. Next slide, please. So who is going to be impacted here? And the answer is everybody who used to be able to stretch has to at least be concerned about the new rules. Okay, the new rules still recognize that there are things called designated beneficiaries. That didn't change at all. What did change is that the Secure Act created this new thing, and this new thing is called an eligible designated beneficiary. And if you're not an eligible designated beneficiary, then you're not going to get a stretch. Instead, as the second bullet on here indicates, you get the 10-year rule. Now, I'm going to shorthand that as the 10-year rule for the remainder of this presentation, but I do want everybody to understand, when we talk about the 10-year rule, it actually is a little bit longer, because what we're going to do is you begin the clock the year after death, and then it has to be distributed by December 31st of the year after that. So, for example, if I were to pass away this year, the clock's going to start in 2021, and my beneficiaries, if they're not eligible designated beneficiaries, have to take the last dollar by December 31st of 2030. The great thing is they don't have to take a dime in the first 9.5 years if they don't want to, but they have to take all the money by then. Next slide, please. So who are these eligible designated beneficiaries that get the stretch? Well, they are surviving spouses, they're minor children of the deceased IRA owner or plan participant, a disabled individual, a chronically ill individual, or a beneficiary that is less than 10 years younger than the deceased. So let's take a second and just go through each of those. Next slide, please. The surviving spouse, their options really didn't change much. Okay? Most of us, for almost every IRA we've seen, the IRA or the surviving spouse just steps in the shoes, right? They roll it over into their own IRA, and then they get to treat it as their own. And that's been great for most folks, right? They can delay it. Now that the RMDs don't start till 72, they get an even longer time to stretch it out. The problem, of course, is that if they want to take that money prior to age 59 and a half, they're going to have to pay the premature distribution penalty unless they find another penalty exception. So this shouldn't work for everyone. Instead, some people might want to consider inheriting the money or inheriting the IRA as an EDB. And if you do that as a spouse EDB, that is, then you can delay it until the later of December 31st in the year after death, or until the participant would have reached age 72. Now, that all sounds dry, and we don't, if you want to know how that's really going to work, we can use me as an example. My wife and I are not close to 59 and a half yet. So if I were to pass away this year, We have 4 kids at home. My wife might need to use some of that money to pay for living expenses, to pay for the house, to pay for college education, any of those things. If she just inherits it as a knee-jerk reaction, because that's what a lot of people do, then she has to wait till 59 and a half unless she gets a different exception. Rather, if she just inherited it, then she could begin that immediately. So anytime you have a spouse beneficiary that is not 59 and a half, you need to at least consider the possibility that they should be inheriting it instead of just rolling it over. Next slide, please. The next individual that would be considered an eligible designated beneficiary is a minor child. And the thing to understand is it's not just any minor child. It has to be a minor child of the IRA owner plan participant. Okay? It can't be a grandkid. It can't be a godson, a niece, nephew, the kids of your cousins or your neighbors, anything like that. If you want to get this, then it has to be your minor children. And if you do, they may stretch and take those distributions out over life expectancy. But this is a big but. Once they reach the age of majority, then they have to take it out pursuant to that 10-year rule. Now, if that sounds like a contradiction, it really isn't, right? You say, well, I thought you just said it was life expectancy. You determine the amount of the payments based upon their age with the life expectancy, but once they reach the age of majority, then you switch over to the 10-year rule. Now, I will admit a couple of times in here that there is just a lack of clarity on a few questions that have come up with these. And this is the first one. And that is, what is the age of majority? And most of us just say, oh, it's 18, 19, or 21, depending on the state you're in. But of course, if the child emancipates, then the minority is done. The other thing that we're a little bit unclear about at this point is if they're under 26 and they're in an approved course of study, then they are still a minor child. So what is an approved course of study? Not sure yet. Now, we assume that that would include a 4-year school, maybe graduate school. What about trade school? I don't know. So we're just going to have to wait for some clarification to come from the IRS on issues like that. Next slide, please. Another eligible designated beneficiary, of course, is a beneficiary, doesn't have to be related, just has to be less than 10 years younger than the IRA owner at the time, well, obviously they would have been at the time of their death, but if they're less than 10 years younger, they can still use life expectancy. Why would the IRS allow this? Well, they would allow it because obviously if you're only less than 10 years younger, they aren't really getting much more of a stretch than the IRA owner would have received had the IRA owner just died. There's no generational stretch on that, right? So it really isn't stretching it out. And as a matter of fact, that beneficiary is going to use the single life expectancy table with no recalculation. So they will actually take it out faster than the IRA owner who was able to use the uniform lifetime table and recalculate every year. So it's a nice benefit, and it really doesn't cost the government much as far as accelerating the taxes. So next slide, please. Disabled people are also able to qualify as eligible designated beneficiaries. And so the reasonable question that you might have there is, what is disabled? And if you are not able to engage in substantial gainful activity, then you're disabled. And you then can take the money out over your life expectancy. Next slide. It's the same thing with chronically ill. And if you're chronically ill, if you're wondering what that is, of course, chronically ill has the same definition that it would have with long-term care or a chronic illness type of rider on a life insurance policy. So if a person can't satisfy 2 activities of daily living or has a cognitive impairment, a severe cognitive impairment, I should say, they are chronically ill, and they will then have the option of taking that out over their life expectancy as well. Next slide. So what happens when that eligible designated beneficiary dies? If you say, hey, I had an eligible designated beneficiary and they had a 40-year life expectancy and they died suddenly, How long do I get? Well, the successor beneficiary is only going to get the 10-year rule. So you have to be careful about that. If you expected to take the money out over 30, 40 years with a young beneficiary, for example, as soon as they die, we start that 10-year rule. So December 31st of that 10th year following the year of death. Next slide. Now, generally, I was only going to talk about individual beneficiaries. I didn't want to talk about trusts because Andrew is going to talk about that in the next section. But I do think I would be remiss if I didn't talk a little bit about non-designated beneficiaries. And when we talk about non-designated beneficiaries, usually what we're referring to is people who are, entities that have no life expectancy because they're not alive. So it might be an estate, it might be a charity, or it might be a trust that just doesn't qualify as a look-through or see-through trust. And so for these entities, if they are the beneficiary, then of course, the rules are the same, which is that if the participant died before required beginning date, then they have to take it out in 5 years. But if the participant died after required beginning date, then they have the participant's remaining life expectancy. And this is where, even though the rules aren't changing, the application of them sometimes makes a difference in your planning. So for example, if you had someone who died at the age of 71, under the old rules, they would have been able to take the participant's remaining life expectancy because they died after required beginning date. But the required beginning date changed from 70.5 to 72. So while they didn't intentionally change non-designated beneficiary rules, they did in effect. The other thing to consider is, wouldn't it be nice if the IRA owner had a longer life expectancy than 10 years? Boy, I sure wish that I wasn't roped into taking that 10-year rule because I'm a child of the, I'm a beneficiary who's not an eligible designated beneficiary. So I would normally be required to take that out under the 10-year rule. Well, pre-Secure Act, you could actually elect to be a non-designated beneficiary. And you would love to do that here, right? If a person dies between 73 and 80, they do have a longer life expectancy than 10 years. And so you would benefit from that. Unfortunately, we don't know that that's the rule yet. So that's number 2 on the we don't know yet list for my presentation. So keep your eyes open. If you have somebody who dies between 73 and 80, we would love for them to be able to take participants' remaining life expectancy. It doesn't appear yet that that's going to be the case, but who knows? We certainly have gotten favorable tax treatment in the past in some other areas, so maybe we will here too. Next slide. So at the beginning of this, I said, here's what you need to do with this information. You need to call your client, you need to have a beneficiary review, and you need to transition then to some other planning techniques. And what I want to share as a planning technique is a Roth conversion, because in post-Secure Act, people who thought they were going to be able to stretch out those benefits over life are now finding out that they have to take it out over 10 years, which isn't a problem for some, but is a problem for others. So because they have to take it out within 10 years, they only have 10 years to take that tax consequence, no matter how big that IRA is. So if we do the conversion during life, of course the conversion requires income taxes be paid by the IRA owner, but of course then it's going to be tax-free to your beneficiaries. So not only is the amount converted going to be tax-free, but the amount of growth on that conversion, post-conversion, will also be tax-free. So now we're doing 2 things. We're managing the stress in our beneficiaries' lives because it's difficult to make these important decisions and it can be such a heavy consequence. So we're removing some of the stress, but we're also really taking away bad tax consequences for them, because we know that IRAs are not great wealth transfer tools. So this is definitely going to ease the burden on your beneficiaries. So If they have an estate tax issue, of course, the savings can be even greater. Next slide, please. I would like to do a quick example of how a Roth conversion might not only save income taxes like we talked about on the last slide, but it can actually save substantially on estate taxes as well. So here are my assumptions. The top estate tax rate, of course, is 40%. We're going to make the IRA owner and the heir both in the same tax bracket. We're just going to make it 37%. The estate size is going to be $3.5 million above the applicable exclusion amount. Now, we know the applicable exclusion amount is going up each year for inflation, at least until 2026, right? So to sort of remove that uncertainty from this example, whatever the applicable exclusion amount is, this example says we have $3.5 million more than that. And of that $3.5 million, there's a $2 million taxable IRA. Next slide, please. So let's do the math on this. If we do the math, we look and we say, all right, what would happen if we did not convert it? Well, we have a $3.5 million taxable estate at 40%, which then would generate $1.4 million in estate taxes, leaving $2.1 million. Now we have a $2 million IRA, which is going to be income taxed at 37%. So that leaves $1.36 million to your beneficiaries if they pay both the estate tax and the income tax. Now, what if they converted it? If they converted it, of course, we would be paying the taxes during life. So what does that do? We start out with a $3.5 million taxable estate, but we pay $740,000 of income taxes during life. So that really leaves us with a $2.76 million estate. And you multiply that by the 40% estate tax, and you get $1.656 million instead. So that's 22% more. Now, for those of you on the call who are good with taxes, you know that part of that is going to be managed by an income in respect of decedent deduction. That at these tax rates might save about $160,000 of that, but clearly you're still much better off if you do the conversion prior to death than if you do it and leave it to the kids to pay those taxes, assuming you're in the same tax bracket. Next slide, please. So what else could you do? Well, something, my personal favorite, of course, being in this industry and working for the company I do, I would like to see people buy life insurance because I know that not only would they have all those tax savings that we just talked about, but you also get the leverage of life insurance, and your client who doesn't really want to pay $740,000 in income taxes to save their kids' income taxes can just drip money into an irrevocable life insurance trust. But I don't want to say any more because then I would be stepping on Andrew's presentation. So with that, I'm going to turn it over to Andrew Wren, who's the Vice President over at Emeritus. Andrew?
Thank you very much, Ron. I appreciate the kind remarks. And I think this is a nice bleed over from your presentation to my presentation. So let's talk a little bit about estate planning. Kathleen, you hit some good business topics. And Ron, you hit the income stuff. And I'm going to go ahead and see if I can go ahead and hit the estate planning portion of this, if at all possible. So let's go ahead and go on to the next slide. Okay, Secure Act and Trust Planning. So as Ron mentioned, how you're designated as a beneficiary can make a huge difference under the Secure Act. And so we're going to spend a little bit of time on that. I promise we'll get into the weeds just a little bit, but not too much, if at all possible. So there's different types of beneficiaries, if you will, under the Secure Act. And we're going to be spending most of our time talking about eligible designated beneficiaries and designated beneficiaries. And you'll see that makes a difference from an estate and an IRA planning perspective. And I think Ron, my cohort in crime, alluded to this already. A designated beneficiary has to be a human being. If it's not, You can have a trust, but the payout rules, especially when dealing with an IRA, are going to work just a little bit differently. So my goal here over the next few moments is to go ahead and ferret out some exceptions to that 10-year payout rule, if at all possible, and see if we could integrate some trust planning into this to stretch out that 10 years into maybe 15, 20, or 25 years. All right, next slide. All right, so just brief review, and Ron hit this as well. So what are eligible designated beneficiaries? This is a new category under the Secure Act. So these are individuals that are not subject to that 10-year rule. So we're talking surviving spouses, we're talking chronically ill and disabled beneficiaries. We defined that already. Beneficiary less than 10 years younger than the participant. That would not be that picture right there. All right, so I think we have a little bit more of an age span there. And then minor children, there's a special rule that we just talked about as far as how that works. Those are eligible designated beneficiaries. Let's move on. Next slide. All right, so let's talk just a little bit trust planning here. So there's a special sort of see-through trust that if it meets certain characteristics, can qualify one with good planning to go ahead and stretch out an IRA over a longer period of time than just 10 years. And hopefully this is as esoteric as we get here, but a see-through trust, that's a special type of trust under the Secure Act. A trust still may be a beneficiary. There's nothing wrong with that. The trust itself just might not be an eligible designated beneficiary. So let's see what that see-through trust is and how it might work regarding those stretch rules. Bring this all together. So see-through trust, it must be valid under state law, it must be irrevocable or become irrevocable upon the death of the owner. And the beneficiaries must be identifiable. They must be people, natural people. They can't be an entity like an S Corp or something of that sort. And the IRA custodian must receive a copy of the trust by October 31st of the year following the participant's death. So those are just the requirements. Let's get into how that makes an actual difference with estate planning for both you and hopefully your client. Let's move on to the next slide. So of those see-through trusts that we just talked about with all those characteristics, and obviously work with your attorney to make sure the trust has those characteristics. There's two types of, I guess, subcategories, if you will. There's something called the Conduit Trust and the Accumulation Trust. So we'll keep this high level. Conduit Trust, the two types of trust, all distributions for Conduit Trust from the IRA are to be paid to the beneficiary. And it's kind of flowing through. The advantage there is distributions from the IRA are taxed at the beneficiary's rate, and not the grantor's, not the person who puts the assets into the trust, in this case an IRA. Disadvantage, less asset protection for those benefits. All right. And a second type of see-through trust, which might help us with more liberal stretch rules, is the Accumulation Trust. And that is a very apt term. All distributions from the IRA in this case are accumulated within the trust, and depending on the trust terms, may be paid out to the beneficiary. The advantage is asset protection. Disadvantage, any income distributed will be taxed at those trust rates, and those trust rates are nasty. Let's take a look at what those might look like in the next slide here. So if you have an accumulation trust, you'll see that if you have as little as $12,950 in the bottom right-hand corner there worth of income, you could be subject to a 37% income tax rate. So in a way that almost makes the case for if we could engage in some smart estate planning under the new Secure Act with a conduit trust, that'd be the best of both worlds, because we can go ahead and pull the assets through the trust, not worry about those trust tax brackets, and be able to stretch out an IRA to those beneficiaries. Let's see what that might look like in the next slide. All right, so this is bringing it all together. All those terms that myself and Ron were just talking about regarding designated beneficiaries, eligible beneficiaries, and just beneficiaries. So this is where it's all at. So type of trust on the left side, if you have that conduit trust, that flow-through trust, if you will, but you don't have an eligible beneficiary, like we just talked about, somebody that's chronically ill, somebody that's disabled, somebody that's a minor. If you don't have any of those 5 categories, you're still stuck with your 10-year distribution rule under the Secure Act. Here's the good news, and it's coming up right next here. If you have one of those flow-through trusts, those conduit trusts with an eligible beneficiary, an eligible designated beneficiary, guess what? You could use a traditional stretch or stretch to age of majority, then 10 years after that, like we were just talking about with Ron. The rest of those are, I'm going to go through very quickly, an accumulation trust with no eligible designated beneficiaries. You're still stuck with 10 years. And there's kind of unclearness regarding the rest of the rules. Really what I want you to pull out of this slide is this conduit trust with an eligible designated beneficiary. Those are new beneficiary designations under the Secure Act. You still have flexibility there regarding stretching out that IRA over a period longer than 10 years. That's still a valid income and estate planning tool, if you would. All right, let's move on. Life insurance application. We want to be able to sell something here, right? Couple options here. One could be to put life insurance on the parent to replace the lost retirement growth, right? If we're stuck with 10 years and we haven't kind of met that conduit trust exception, life insurance can go ahead and make up the difference for the accumulation which we'd otherwise have in the estate. You might want to use life insurance to push back against the reduced value of taxes on a Roth conversion like we were just discussing. And then life insurance can also work to go ahead and pay those income taxes on those non-covered traditional IRAs because of the higher exposure to those marginal tax rates. So again, if we don't do a Roth conversion situation, life insurance can work in lots of different situations. Let's move on. I want to hit a few more opportunities and then go ahead and open it up for opportunities for you to ask questions of both Kathleen, Ron, and I. This slide here is just utilizing life insurance. In some cases, you might want to go ahead and integrate that inside of an ILET, an irrevocable life insurance trust, to keep those proceeds outside of the estate. Let's move on here because I want to hit some of these other ones really quick. Next slide, please. Okay, Sharable Planning. Sharable Planning is not dead at all. It's still out there, and arguably now more than ever, especially with the Secure Act and those 10-year stretch provisions, people are utilizing Sharable Planning, donating even IRAs now more than ever before, because those can make great vehicles for meeting both one's philanthropic needs and also financial planning needs as well. So a CRT is big right now. I'm hearing a lot about that. So how do you use that? So utilize a CRT as a beneficiary of an IRA. So instead of doing a traditional inherited IRA, use a CRT as a beneficiary. Now this is not a designated beneficiary in the human sense. So going back to those rules that we were talking about before, if you do use a trust in that manner, you have a 5-year payout if the participant dies before the required beginning date, and then it's their life expectancy thereafter. But the point is this, and let's go on to the next slide here. If you use a CRT as a beneficiary of an IRA, once the money goes into the CRT is a tax-exempt vehicle. Again, it's tax-exempt. So those monies coming back out of that CRT could be used to go ahead and fund 2 different things. An income interest for the donor's children. So let's say the IRA participant was dad. He went ahead and got his IRA into a CRT. The income beneficiaries could be mom and dad's kids. So it could be spread out over their lifetime or for a period of 20 years. The remainder interest, for those of you that are familiar with CRTs, what's left in this CRT at death could be used to benefit a charity. So something really fundamental has happened here. Even though we have a trust that we're looking at that's not a human, that's still subject to those 5-year rules, once it's actually into the CRT, we could use that income interest to go ahead and pay out to children, in some cases grandchildren, a period that's in excess of 10 years. Very powerful tool there. Use CRTs. Think about them when you're dealing with some of your affluent clients. Let's move on. Then we'll wrap it up and see if we have some questions. Let's go past this next slide because I want to go ahead and keep going here. Beautiful. Last slide here, at least on the estate planning portion of today's presentation. Think now under the current economic environment about using things like grants, clats, gifts, intrafamily loans, exchanging assets with suppressed asset values and income rate or income interest rates extremely low. This is a great environment to engage in techniques like that. I was dealing with one of our top producers yesterday, and we're just talking about integrating a clat strategy with the low interest rates. Those same strategies work really well with grants. Think about gifts, the exemption amount, that amount you could pass on to somebody else free of gift and estate taxes. That's around $11.5 million. Under current legislation at the end of 2025, that's going to go ahead and go back to a $5 million index figure. This is a great time to engage in gifts. Loans to family members at low interest rates. The 9-year term rate right now is like 0.45. And lastly, exchanging low basis assets for high basis assets in and outside of a grantor trust. That's a higher end strategy, but it could make a great estate and income tax play as well. But I want you to pull all this last slide, think about some of those other strategies above and beyond just stretching out an IRA. That's a big one. But think about grants, clats, and some of those other estate planning strategies. We're in a great economic environment for that right now. Okay, that's the end of my estate planning portion of our presentation. I think we're going to open up for questions now.
Well, thank you, Kathleen, Ron, and Andrew. What a great presentation, and trying to do these high-level topics in just 15 minutes or so was outstanding. So we do have some questions that came through the Q&A and the chat room. Ron, I want to go back to you. One question was, how do these institutions track the correct beneficiaries and assure the proper payment amounts are taken?
You know what? You're actually asking the $100,000 question, because nobody knows. At this point, we're really trying to find our way through this, right? Because, for example, if I bought a life and 20 with my wife, I'm completely entitled to do that with my IRA. But what happens if we both die in year 5, for example? Then all of a sudden we have 15 years left of an annuity, and they're bound by the 10-year rule. So it's a great question. And unfortunately, we are, at least at our company, we're still working through that. I don't know if Andrew's company has finalized that yet, but I suspect most people are in the same boat as us.
Andrew?
Same boat, Ron.
Yeah. Kathleen, this next question is for you. What type of plans are you seeing companies doing today? We have to unmute her. All right, we're going to skip Kathleen for the moment. Andrew, you talked about CRTs as income beneficiaries. What are some opportunities with CRTs from an estate planning standpoint, or how can these people get estate planning benefits from their CRTs if they're an income beneficiary?
Yeah, that's a great question. And to your point, boy, I sure wish we had more than 15 minutes, Keith, to discuss some of these techniques. But we'll keep this short. A couple ways, Keith, to answer your question. Number one, within the context of what I was talking about, you're utilizing an IRA and removing it from your estate. It's including your estate for estate tax purposes, but because it's going to a charity, you get a corresponding tax deduction on your estate tax return. That's one estate tax benefit. The other one, I think, is even bigger, frankly. I talked about obtaining an income interest for the donor's children once the income starts spinning off of that CRT. You know, Keith, there's no good reason why that income couldn't be used to fund what we in our profession call a wealth replacement trust. Yes. That trust could own life insurance. Who are the beneficiaries of that life insurance? that children of the donor, the very individuals, might have been subject to that adverse 10-year stretch, but now they're going to be beneficiaries of a tax-free life insurance policy through a trust. I think that's the biggest estate planning play right there, Keith.
Great, that's a great idea. Kathleen, while we have both of you and Andrew, you wanted to ask Andrew a question about, or make a comment about conduits versus accumulation trust today.
Yes, actually. Hi, Andrew.
Hello, Kathleen.
I just wanted to comment that we are working with a lot of clients right now to amend their trust to move from a conduit trust to an accumulation trust. It's a great way to get out in front of clients. I mean, this change in the law with Secure has been a great way to get out in front of clients, talk to them about their estate plan, really drill down to what's important to them, whether it's the income tax or the asset protection for their beneficiaries, because to a certain extent, it's a trade-off.
Yeah, and Kathleen.
It is.
Go ahead, Andrew.
Yeah, I'm sorry. Go ahead, Keith. I was just going to say, Kathleen, you speak from the point of an actual practitioner,
Yeah.
and there's no change in the tax law I suspect that you're not happy about, right? It gives you an opportunity to get back in front of clients.
Absolutely.
Yeah. Kathleen, while we still have you, what type of plans are you seeing in your practice today, advisors bringing to you or recommending to you?
Well, Keith, I'll tell you, I have a little bit of everything on my desk right now, everything from an incentive stock option plan that I'm working on to split dollar. But the most popular plan by far, I would say, is a phantom stock plan. The reason for that is I think it's available to all types of entities. So, an S corporation can put one in place without violating the second class of stock rules. They're very flexible. Vesting can be either time vesting or performance vesting or both. So we have a lot of flexibility to put all the pieces together for the client.
Thank you, Kathleen. And we do have probably time for a couple more questions, but before we get to those, I want to remind everyone, this recording is available at bigideas.nafa.org. It's also available at fspgo.com/shop/ and NAPA's YouTube channel. Also, we have these same 3 great presenters in August who will present a program we call Meet the Feldmans. We've already done this live. It's a 3-part, 1 hour apiece program on August 5th, 12th, and the 19th from 2 to 3 p.m. Eastern Time. We do have CE credit available. For more information, we will get some out. This is another great partnership event from the Society and NAFA. So once again, I want to thank Kathleen and Andrew and Ron for all their support and helping us get this partnership with the Society off the ground. So Ron, you had some really great Roth ideas, and I think that I'd like you to comment on another one today. Even with the 10-year stretch, I think that you have some people who make this Roth contribution. There's the estate tax benefit. You're basically making gifts to your children, but then talk about that 10 years. What can happen to that money over that 10-year period of time in a Roth?
Well, if I'm following the question, I think obviously you can have a tremendous amount of growth between the date of the participant's death and 10 years. If it's in a Roth, all of that is growing tax-free. So you get using the rule of 72, you get a 7.2% rate of return. In 10 years, you have twice as much money as if you took it out the day after. And it's all going to be 100% tax-free. So is that kind of where you were going? Because
that's the point. And I want to get
a wonderful opportunity.
I want to get to one more question for Andrew. I know we're right at 2 o'clock. Andrew, there was a great question that came in looking at a CRT being the beneficiary of an IRA. On a husband and wife first death, does the retained interest income stream to the spouse qualify for the unlimited marital deduction?
Yeah, anything that's retained that's going to be going to a legitimate spouse is going to qualify for the unlimited marital tax deduction. There's nothing about the Secure Act that eliminated the normal estate planning rules there, but probably right, Keith. So I think we're good there.
All right, everybody.
Hey, Keith, before we go,
yes,
may I just bring up one more thing?
Absolutely.
You mentioned FSP Go, which is a brand new offering from the Society of Financial Service Professionals. It's basically the newest way that FSP is moving financial advisors forward. So FSP Go is a new website where financial advisors can find the latest and most effective tools and educational programs to grow their practice and drive revenue. And right now that's so important. It's consistent with the need for virtual learning and personal convenience. And it offers a mix of FSP created content as well as content from our partners like Sandler Training, the American Law Institute, Brand Builders. So I'd encourage everybody to go check it out, fspgo.com.
Thanks for saving me on that, Kathleen. I appreciate it. Everybody, thank you. Thank you very much. The slides will be available. Thanks.
Thank you.
Thank you, everyone.